Many believe there is 6,500 different languages across the globe. But it doesn't stop there, because many different industries, many different fields of expertise seem to have their own secret language, and trading is certainly no different. Let's talk about that. Hello there, this is James, and you're watching the latest episode of Trading Bites. Now, Trading Bites is a new educational series I'm trying to put together. And the reason why it's called Trading Bites is because it's like little bite-sized pieces of education to really sort of whet your appetite. Obviously, we'll do bigger courses, a lot more in-depth courses down the line. For now, this is just sort of giving you a little bit of introduction into trading education. Today's episode is quite a favorite of mine because it delves into the different market jargon used regularly in the trading industry, which I want to cover. But before we get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand for entering any trade. With that out of the way, let's get started. So yeah, like I said at the very beginning of this video, before the title sequence, every industry has its own secret language, its own words and expressions used to describe certain aspects of a role in that industry. And the trading industry is no different. No doubt, beginners coming to for the first time coming into the industry will hear expressions or words said on a regular times. And you find a little bit confused what that actually means because they won't explain it. They don't explain what certain words mean in Bloomberg. They just accept that you should know what it means. But if you're beginning in this industry, then it's a little bit difficult to sort of know that because you don't know what it means. So this is what we're going to do a little video on today. And I want to start off with, like a mini segment. Like I said, this is an introduction to market jargon. There is a lot more expressions, but today we're just going to go through a couple of them, some of the ones you hear regularly. But I'd like to start off with a little segment about what I like to call the animal kingdom of market jargon. Bears. These are pessimistic individuals who believe an asset or the market is going to go lower. So they're what's known as being bearish. So say, for example, I thought the euro was going to go lower. I'll be bearish on the euro. The opposite of that, of course, are bulls. These are optimistic individuals who believe an asset or the market's going to go higher. So they're what's known as bullish. So if I believe gold was going to rise, I'll be bullish on gold. Hawks. Now this refers to central banks or central bankers who are hawkish on the state of the economy. They might be thinking the economy is strong and drop hints aggressively that they're going to raise interest rates. And that's, of course, complete opposite to the next one, which are the little old doves. These are, again, central banks or central bankers who are dovish on the state of the economy, i.e. they believe it's weak and they drop hints that they may lower interest rates in the future. Yeah, so there we go. There's some of the animals in the animal kingdom of market jargon. There is others, such as, for example, a bit of a funny name, a bit of an unfortunate name called the dead cat bounce. This is when an instrument or an asset is on a downward trend, strong downward trend, and all of a sudden sort of does a little bounce before then continuing its downward journey. That's called a dead cat bounce. There's also likes of piggies and sheep as well. But the main ones, like I say, are bears, bulls, hawks and dovish. That is what you will hear regularly when you read the financial news. Just a little side note, the reason why bears are called bears and bulls are called bulls is because when a bear attacks, it attacks like this, paws down. When a bull attacks, it attacks like this, upwards with its horns. Just a little bit of, something which I always find funny. But anyway, let's go on to other market jargon. What you will hear a lot. Long. Go long. American football, but not quite. When someone says, I'm going to long or go long, basically what they're saying is, I believe that asset's going up, so I'm going to buy that asset. So long means buy an asset because you believe it's going to go up in value. When they say go short, it has nothing to do with me, I'm only 5'5". They mean the opposite of long. Go short means they are, or in the belief that asset's going to go down in value, so they're going to sell the asset. So when I say I'm going to short the British pound, it means I'm going to sell the British pound. The short means sell. Stop loss. This is certainly something that beginners should hear about and learn about. A stop loss is a particular level you put in your trade that if it goes against you and the market hits that level, before it can go any further, it will take you out of the market, minimizing your losses. Take profit sort of gives it away a little bit. It's the opposite stop loss. That's the level where you put in your trade, where you think the asset's going to go down, to close that trade and lock in your profit. Okay, take profit, all right? Margin call. Margin call. There was actually a very good film with Jeremy Irons and Kevin Spacey called Margin Call. But what does margin call mean in the trading industry, related to the trading industry? Margin call is when you say you don't have a stop loss and you have a position open and your equity in your account has gone so low, and i.e. that position is gone against where you originally thought it was, so you're in a loss. It gets to a certain level of your equity, where if it goes to a certain level, that position will automatically close. But before that happens, you get what's called a margin call, which is like a warning. Now that margin call will either let you know to either top up your account with more finance to keep that position going, or maybe liquidate some other positions you have to free up your equity. So that's margin call. What other things will you hear on a regular basis? Uptrend. Now uptrend, pretty much we'll say, what it says in the tin, is when an asset is basically on a trajectory of going higher for a while. It's on an uptrend, so it's continuously going higher. We're on an uptrend, moving up. Downtrend is the opposite. So if an asset is obviously struggling, it's on negatives, it's on a downward trajectory. So downtrend, you hear that as well. I'm trying to think, a couple of my other ones are my favorites as well. Fat finger. Fat finger. They do have some funny expressions. Fat finger is when you suddenly see a drop or spike in the market caused by human error. What do I mean? In other words, put it in layman terms, say a trader on the floor to put an order in to buy, say, Microsoft. You were supposed to do, say, 5 million contracts in Microsoft. But by accident, he's typed in an extra digit or two. So it's now like, say, 5 billion, which makes the market spike. So it's like a spike in the market caused by human error. It's human mistake. It's called the fat finger. But humans aren't perfect, but computers aren't either, because you have what's known as a flash crash. Flash crash is when there is a certain movement in the market and black box solutions, like these computer algorithms, these amazing computer technology, amazing programs people put together, makes a mistake and it spikes the market down. And before the market then corrects itself. So it's like I say, it sort of overrides. It's not human error, it gets confused or it sees certain conditions and it does a big movement in the market, causing the whole market to sort of crash downwards or crash upwards before then correcting itself. It's called a flash crash. So like I say, it's not just humans which can make a mistake. So those are some of the famous expressions, but there's other expressions as well, other jargon when it comes to say currencies, for example, which you hear a lot. You will hear a lot. When somebody talks about the euro in relation to Forex, they're talking about the euro dollar. When they are talking about the cable, and you will hear this a lot, I often make the mistake when I'm talking about the market. I say the cable, not aware that maybe people watching it might not understand what the cable is. When they say the cable, they are referring to the British pound, US dollar pair. That is to do with relation of the cable which connects New York to London under the Atlantic Ocean. So when they say cable, you mean the British pound, US dollar. The yen. Come to currency pairs, they're talking about the dollar yen. The loonie. When they say the loonie, they're talking about the US dollar, Canadian dollar. That's because the national bird of Canada is a bird called the loonie. Nothing against Canadians, it's about the bird, okay? So I'm not saying the Canadians are loony, it's to do with the bird. So it's called the loonie. When they say stuff like the guppy, which I talk about a lot, the guppy is the nickname for the British pound, Japanese yen. The Aussie, that's the Australian dollar, US dollar. Kiwi, New Zealand dollar, US dollar. The yellow metal, I talk about that a lot because those who know me, they know I'm a big gold trader. That is obviously to do with gold. Trying to think of another one. Red metal, copper. The yuppie, that is euro, Japanese yen. But anyway, the ones you hear the most, certainly when you're watching the financial news, which might catch you off guard, is they say the cable a lot. Euro dollar, they talk about the euro dollar is the most liquid pair. But when they say the cable, they talk about the cable a lot. It's the British pound, US dollar, and they do refer that pair to that pair at the name a lot. So anyway, that's sort of like a bit of the insight into market jargon. Like I said, this is just an introduction. It's just trading bites. Obviously, down the line, I'll do a lot bigger courses on this subject. So just giving you a little taste of, just to sort of introduce you to this secret language of the markets. But anyway, I hope you enjoyed this little video. Till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand for entering any trade. Till next time, every single one of you, trade